Greetings, NIRVC's family of customers and friends. You probably noticed we had one of those months when decades happened in April. Fast-moving events are very hard to cover in a video. Anything I said during its filming in April could be rendered laughably wrong by the time it goes through editing and you get to watch this video. However, we know some things with relatively high confidence, and that's where I will focus in on this video. Financial markets have seemingly become all about tariffs in the stock market, all of the time. So, not surprisingly, after two back-to-back customer appreciation reunions during the weeks of April the 7th and April the 14th, tariffs in the stock market were most of the questions, concerns, and what our customers wanted to discuss. Now, juggling all of this is complicated to say the least, so consider yourself warned. This isn't going to be a short video. However, there are chapters so you can break your viewing boredom into shorter segments according to your tolerance for monotony. I will try my best to cut through some of the fog in this edition of The World According to Brett. I'm certain many, if not most, within the sound of my voice, will disagree or be offended by some of my thoughts. Please know, when it comes to business and the economy, I always endeavor to remain unemotional and politically agnostic. Approaching business or the economy with emotional or political views is a fool's errand which always ends badly. This video will not be a political commentary. Given we all know what our economy has looked like and how it has behaved for decades, wouldn't it behoove us to try and look ahead at what could happen? Be it good or bad, should the Trump administration be able to execute on some, part, or all of their agenda? As the President and CEO of National Indoor RV Centers, it is my job to try and look out over the dashboard at what could be coming at us, and then position and prepare NIRVC for whatever ups or downs our economy may take. In keeping with our tradition of videos, this video will have a lot of data because an opinion without any data, well, it's just another opinion. So let's collectively hold our noses and jump in to what the facts and the data are telling us. Personally, I think a U.S. trade deficit is neither good nor bad. Clearly too large of a deficit is bad, but a trade surplus could also be very problematic and probably worse, as I will explain here in a few minutes. I feel it is important for the U.S., or any other country for that matter, to have some degree of self-sufficiency and to support its own workers and manufacturers. However, some segments of our economy are more important than others and do require slightly different approaches. Tariffs may or may not be the answer in some segments, but could also be the only answer in other segments. As with every solution, there are always trade-offs. The U.S. buys a lot more stuff from the rest of the world than the rest of the world buys from the U.S. The difference is called the trade deficit, and as you can see from this chart, we have had one almost every year since the 1970s. The trade deficit tends to shrink a little bit when consumer spending drops during recessions, but we have not had a significant trade surplus for many decades. However, that doesn't mean that the U.S. exports are falling. They have grown quite a bit. Here's another chart showing trade in goods. The blue bars are U.S. exports, the black bars are our imports, and the red line is the difference, or our goods trade deficit. However, if you look at services rather than goods, the U.S. exports more than we import. American companies and workers are good at making non-tangible things like software, movies, TV shows, music, and all kinds of business services. The world wants these things and happily buys them from us. But these things are not critical to any country's survival or supply chain, including our own country. By combining both goods and services, the U.S. runs an overall trade deficit, and this trade deficit exists because our imports have grown faster than our exports. To be more precise, in 2024, the U.S. exported a total of $3.19 trillion in goods and services and imported $4.11 trillion worth of goods and services for a trade deficit of $920 billion. which was also a new record. Our trade deficit grew by $133.5 billion in 2024, or a whopping 17%. For some perspective, the U.S. is the world's largest importer of goods and services and runs the largest deficit. Our trade deficit is 5.4 times larger than second-place Mexico with a $172 billion trade deficit in 2024. In fact, the U.S.'s trade deficit is larger than countries numbers 2 through 10 combined. By comparison, China exported $3.575 trillion in 2024, which was $385 billion or 12% more in exports than the U.S. However, China only imported $2.587 trillion in 2024 for a trade surplus of $988 billion. Yes, that's right, China's trade surplus was larger than the U.S.'s trade deficit. The delta between China's surplus and the U.S.'s deficit was an eye-popping $1.91 trillion in just 2024 alone. Cumulatively, the 25 countries with the largest trade surpluses generated a whopping $3.06 trillion of surplus during 2024, and 30% of that surplus came from the United States. Now that we have discussed our trade deficit in terms of absolute dollars, let's look at what really matters most. Just like in our own lives, what we owe is only part of the equation. The other part of the equation is our income. Someone whose income is $1 million per year can obviously afford more debt than someone whose income is $100,000 per year. And it is no different with our country. Let's look at the U.S.'s total debt relative to its gross domestic product, or GDP. Currently, our debt totals $36.2 trillion, and we generated $29.2 trillion of GDP during 2024. Our debt is 124% of our GDP. Here's a list of the 15 countries whose debt exceeds their GDP. The U.S. ranks 10th on this list. However, I'm certain none of us envy any of the 9 countries whose debt to GDP is higher than ours. In fact, I'll bet none of us envy any of the 5 countries on this list whose debt to GDP is lower than ours. When it comes to debt as a percentage of GDP, the U.S. is not in good company. The U.S. dollar became the world's reserve currency in 1944 during the Bretton Woods Conference. This conference established a new international monetary system where countries agreed to peg their currencies to the U.S. dollar, which was easy to do at the end of World War II because the rest of the world had been decimated. Since 1944, the U.S. has cumulative trade deficits of $25 trillion, or 69% of our nation's total debt of $36.2 trillion. If these ever-increasing trade deficits are left unchecked, we can follow them to their logical conclusion, which would be our nation will own a whole bunch of stuff we purchased from other countries around the world with our dollars, and those countries are using our dollars to purchase our debt, our real estate, and our businesses. At some point, it will beg the question of who owns and controls the United States. Will U.S. citizens be employed by U.S.-owned companies, or will they be employed by companies owned and controlled by other countries? Will our foreign creditors control more of our supply chain than we do? How long will our foreign creditors continue to sell us their stuff in return for our debt? Our trade deficit is clearly producing trends we should all be concerned about. For example, look at this chart and statement from the Federal Reserve. Quote, foreigners held a record $16.5 trillion in U.S. corporate stocks as of Q4 2024, marking a strong 23.9% year-over-year increase. From 1990 to 2024, foreign holdings of U.S. equities grew at a compounded annual rate of 13.2%. Their share of total U.S. stock market capitalization rose from 9.3% in 2000 to 27.1% in 2024, end quote. The fact foreign ownership of U.S. stocks has grown at a compounded annual growth rate of 13.2% for the past 34 years should be very sobering. If that rate of growth continues, it means foreign ownership of U.S. businesses will double every 5.5 years, which means in 5.5 years, foreigners would own 54%, or a controlling interest of the U.S. stock market capitalization. We're also seeing these trends in both our real estate and bond markets. Again, if left unchecked, U.S. trade deficits are slowly transferring both ownership and control of our country to other countries around the world in return for the stuff we consume. And all of this without a single shot ever being fired. Here's some food for thought. China has been in one war since 1979, and it was the Sino-Vietnamese War. The conflict lasted for about a month. It involved troop deployments and military resources. Estimates suggest China mobilized around 200,000 soldiers and their equipment. The war's brief duration and limited scope kept costs very low compared to prolonged conflicts. Unfortunately, since 1979, the United States has been involved in 11 major conflicts, which has cost $4.233 trillion so far. Can you spot the differences in strategy between the U.S. and China? Eventually, history will tell us which strategy produced a better return as measured in dollars, but not in terms of blood. Personally, I don't care if we are dependent on Bangladesh for our t-shirts, or Vietnam for our sneakers, or China for cheap toys for our kids. However, I think we should all be very concerned about who supplies us our pharmaceuticals, our semiconductor chips, our energy, our ships, our steel, our rare earth minerals, and the list goes on. Now, I would like to shift gears and discuss why I mentioned earlier that trade surpluses could be more problematic or probably worse than trade deficits. In its most simple terms, the process I just described looks like this. We buy stuff from foreigners and give them our dollars. We sell stuff to foreigners and dollars come back, but the flow never stops. The speed of that flow helps drive currency exchange rates up and down. This is why trade policy and currency values are so closely linked. To understand trade, we must understand money. Money is the most liquid of assets, and it is the medium of exchange we use to purchase goods and services. Without money, we would need some form of a barter system. Most sovereign states issue their own currencies, but among those, it's normal for one currency to reign supreme over all others. We call this the world's reserve currency, and since 1944, it has been the U.S. dollar. Central banks hold dollars in reserves. Most international transactions settle in dollars. As a result, the non-U.S. world needs a lot of dollars. It is the grease that keeps the global economy turning. This means the U.S. must constantly export more and more dollars to meet the world's demand. This demand for our currency makes it stronger, which in turn makes our imports cheaper and our exports more expensive. This has been referred to as an, quote, exorbitant privilege. But in some ways, it's also a burden. For starters, Americans are incentivized to save less money and spend more on imported goods. Think about this statistic for a moment. As of March 2025, the personal savings rate in the United States is 3.9%. This rate represents the percentage of disposable personal income that households save rather than spend. Care to guess what it is in China? It is 44.3%. The Chinese people save at a rate more than 11 times higher than do Americans. Given our exorbitant privilege of issuing the world's reserve currency, I don't think we should be aspiring to bring back low-paying jobs that can be done elsewhere. We need to be moving up the income and productivity scale and exploiting our competitive advantage. Let's take a look at Singapore as an example. In 1959, Singapore was doing the equivalent of t-shirts and the assembly of trinkets. Singapore has moved up the manufacturing curve and is now a high-end export machine, trading power, and global financial center. Singapore no longer relies on t-shirts, and the same story could be told for China, Taiwan, South Korea, and the list goes on. So, what exactly are those exorbitant privileges and comparative advantages that we enjoy as the world's reserve currency? And shouldn't we be trying our hardest to exploit them? First, it is important to note that global trade is not a zero-sum game if you are the world's currency. For example, if you're not the country with the world's reserve currency, like say a Latin American country, or any part of 90% of the rest of the world for that matter, you need to balance your trade or your currency is going to devalue, which will reduce the buying power of your citizens while creating inflation. Here are some of the key advantages the United States enjoys due to the dollar being the world's reserve currency. 1. Lower borrowing costs. The U.S. can borrow at lower interest rates because there's a high demand for dollar-denominated assets. 2. Trade deficits. The U.S. can run larger trade deficits without facing a balance of payment crisis as its imports are purchased in its own currency. 3. Currency stability. The dollar's status provides stability and liquidity in global markets. And 4. Economic influence. The U.S. has greater influence over global economic policies and financial markets. Yes, it is a mathematical certainty that the world's reserve currency must run a deficit. Our trade deficit is simply the side effect of being the world's reserve currency. If we were somehow to start running a trade surplus, the rest of the world would become starved for dollars, and that would have side effects as well. For one example, the dollar would strengthen sharply enough to make our exports unaffordable to others. That wouldn't be good for American manufacturers and their workers. Moreover, if this surplus persisted, then some other currency would take on the role of the world's reserve currency and gain the exorbitant advantage that comes with it. The better way to think about all of this is the U.S. imports goods and exports an equal amount of dollars. Dollars are our top export. We can make them cheaply and trade them for all kinds of other useful things and on very attractive terms. However, this short-term advantage can also produce long-term problems. The monetary policy that keeps trade flowing makes the U.S. a permanent debtor nation. Overseas, it does the opposite, producing excess savings. Both cause imbalances that only get worse over time if left unchecked. Since we have the exorbitant privilege of being the world's reserve currency, we really want to keep that privilege, which I believe means that we must act responsibly irresponsible. The U.S. must continue to inject our currency into the global markets at size, which means we are required to run trade deficits. The simple fact is, if we stop running deficits, we will eventually lose the ability to be the world's reserve currency. That's just math, not policy. Clearly, broad-based tariffs aren't a good solution either. As I've just explained, I believe persistent U.S. trade surpluses would upend the global dollar-based trading system. Where that would lead is hard to say, but it's unlikely to be good. See the dilemma? We want the advantages of free-flowing trade, but we also want to protect our domestic producers and workers from foreign competition. Admittedly, having our cake and eating it too means walking a very tight rope. So, what does acting responsibly irresponsible look like? How tight is that rope we must walk between the growth of our GDP versus the growth of our trade deficits in order to maintain our exorbitant advantage? Economic theory suggests our trade deficits should clearly grow at a rate that doesn't outpace the growth of our GDP. This balance would ensure that our country can maintain its debt while maintaining economic stability. If our trade deficits grow too quickly relative to our GDP, it will lead to increased borrowing costs and potential economic instability. Conversely, a slower growth rate indicates stronger domestic production and a reduced reliance on imports, which would lead to the trade surpluses and the risk of losing our advantage of being the world's reserve currency. Unfortunately, the data shows the U.S. has failed miserably at walking this tightrope. From 2000 through 2024, the U.S. has grown its GDP at a compounded annual rate of 2.1%, while growing its trade deficit at a compounded annual rate of 6.1%. We are growing our trade deficits almost 3 times faster than we are growing our GDP. I would like to point out, when something appears to be unsustainable, it's a good bet it's unsustainable. With that groundwork laid, I would like to move on to tariffs. I would like to break the tariff discussion into 3 parts. First, I would like to discuss the historical impact of tariffs. Second, I would like to offer up my thoughts on the Trump administration's approach to negotiations with our trading partners around the world. Then third, I would like to apply actual numbers in order to stress test both best case and worst case scenarios. This chart looks at major historical trade policy events, both protectionist and liberalizing, and tracks how key economic indicators evolved over the 3 years following each policy's implementation. The columns measure the change in average tariff rate, trade balance as a share of GDP, real GDP, equity market performance, and inflation. This approach is designed to match the time horizon most relevant to investors by capturing the first 36 months after each policy is enacted. Generally, the tariff periods don't look particularly different from the full period average from 1821 through 2024. I suppose one could argue that equity returns look slightly lower and inflation slightly higher, but the differences are minuscule for the time periods involved. Clearly, over a 203-year period, tariffs have proven not to be a game changer. So, what is the Trump administration's real objective with its global broad-based tariffs? Here, I feel obliged to disclose that I don't spend much time, if any, reading or listening to what is commonly referred to as mainstream media. The overwhelming majority of my information comes from a plethora of subscriptions because I believe things are generally worth what you pay for them, especially when it comes to research data. I have always craved good, reliable data and from providers who have stood the test of time with me over the decades. Now, with that disclosure out of the way, I will state unequivocally, I have not read, nor have I heard, of anything coming directly from the mouths of President Trump's cabinet that would suggest any desire to try and create trade surpluses with tariffs and thereby jeopardize the U.S. dollar as the world's reserve currency. Rather, they have been very vocal about addressing trade imbalances and supporting policies aimed at reshoring certain manufacturing jobs to ensure the long-term stability in key segments of our country's supply chain. I firmly believe they want to bring the rate of growth of our GDP and trade deficits back to parity. The Trump administration would like to increase the compounded annual growth rate of our GDP to 3% by reshoring pharmaceuticals, semiconductors, energy, shipbuilding, plus several other key segments of our country's supply chain. Increasing the growth rate of our GDP to 3% will naturally reduce the growth in our trade deficits. We're not talking about earth-shattering numbers here to accomplish 3% GDP growth, and certainly nowhere near the emotional reactions we saw in our markets during the month of April 2024. Let me try to paint the picture with some real numbers. Our country's GDP in 2024 was $29.2 trillion. Achieving a GDP annual growth rate of 3% would equate to $876 billion in growth each year. This means to achieve parity, the Trump administration's nirvana, we only need to reduce our current trade deficit of $920 billion by $44 billion, or 4.8%, down to $876 billion. And presto, we will have achieved matching growth rates of 3% in both our GDP and our trade deficit. Given the Trump administration has already secured commitments for over $8 trillion in new capital investments spanning across various sectors, including technology, manufacturing, infrastructure, the objective of matching the growth rates of both our country's GDP and its trade deficits look to be very achievable. Even assuming the $8 trillion takes up to 4 years to be fully invested, that's still $2 trillion per year, or 45 times more money than the $44 billion required to reach the 3% parity in GDP and trade deficit growth rates. Yes, I understand it currently takes 38 months to build a semiconductor fabrication plant in the U.S. But remember, the very second money is being spent on engineers, architects, contractors, steel, concrete, and construction workers, new capital and jobs are coming into our economy. Our GDP will increase, and upon completion of the plant, all those jobs required to build the plant will be replaced with the permanent jobs required to run the plant. Trade deficits are something every single administration since 1944 has had to cope with, and they have tried to address the deficit in as many ways as there have been administrations. No doubt, I have always viewed too large trade deficits to be a problem, and to my knowledge, no country we run large trade deficits with, or who we provide defense to, has ever voluntarily come forward to say, let's renegotiate our trade terms on more favorable terms to the U.S. It's never happened. In my mind, the Trump administration is just one more administration taking a stab at trying to solve the problem. So, why do I think President Trump implemented broad-based tariffs across the globe? While I'm not opining on the approach, let me try and answer the question this way. For all the years I owned banks, we began every loan committee meeting by saying, if a borrower owes us $50,000 and can't repay us, he has a problem. If he owes us $50 million and can't repay us, we have a very big problem. Well, the U.S. is both the largest borrower and the largest consumer on the planet. Total global debt of all sovereign governments is $98 trillion, and the U.S. comprises $36.2 trillion of that, or 37%. Global personal consumption was $60 trillion in 2024, and U.S. consumption, what we spend purchasing stuff, was $17.5 trillion, or 29%. I can assure you, we never had 37% of our bank's balance sheet lent to one borrower. No bank ever has, not even a fraction of that percentage. Banking regulations have never allowed anywhere near that level of risk concentration. So, when the U.S. and its 37% of global debt and 29% of global personal consumption decides not to continue to play along as usual, yes, the world has a very big problem. A big enough problem that all our trading partners around the globe are wanting to come and negotiate new trading terms. Will President Trump be able to negotiate better trading terms than the U.S. currently has? Remember, this is not solely about tariffs. The threat of tariffs is just bringing everyone to the negotiating table. For example, will President Trump accept reimbursement for part of the defense the U.S. provides other nations in lieu of tariffs? Will he accept our trading partners lowering their tariffs in return for no U.S. tariffs? Will he accept investment capital in the U.S. for reassuring critical sectors of our nation's supply chain? President Trump did all of the above during his first term. Given he has already secured over $8 trillion in investment capital and inked a deal with Ukraine to have access to their rare earth minerals, plus share in their profits, I would say early indications are his heavy-handed tariff approach is working so far, but only time will tell. What are the risks if the president's negotiations fail and he doesn't improve our country's trading terms one iota? After all, there have been 15 administrations since 1944, and none of them have been able to solve the problem of excessive trade deficits. Ha! Statistically, history would indicate President Trump has a 1 in 16 chance of success, or a 6.25% probability. So let's apply some very simple, high-altitude math to our downside to see if the markets are overreacting or if they might have it right. In 2024, U.S. personal consumption was $17.5 trillion, and we imported $4.11 trillion. Bottom line, we imported 23.5% of what we spent on stuff. I haven't had the time to put the varying ranges of tariffs good by good, service by service, and which ones are exempted into a spreadsheet. Instead, I'm simply going to use the 10% across-the-board tariff the administration is using for shorthand. If we apply a 10% tariff to $4.11 trillion of imports, that would be $411 billion in tariffs year one, which is in line with the Trump administration's statement that they intend to generate $5.2 trillion over the next 10 years. $411 billion in tariffs means our consumption will now cost us $17.911 trillion instead of $17.5 trillion. Or, put another way, the most tariffs will increase our inflation by is 2.3%. But when added to our current rate of inflation, total inflation could hit 4.7%. I believe that's our worst case inflation scenario. First, it assumes President Trump doesn't improve our current trading terms one single bit. Second, it assumes we will never see the $8 trillion in foreign capital investments he has secured so far. Third, it assumes we don't increase our domestic oil production to bring down the cost of our energy and lower our inflation. And fourth, it assumes he remains firm with his imposition of tariffs as stated. For what it's worth, I don't place the probability of all four of these assumptions happening at 100% either. I would be remiss if I didn't share my biggest concern though. Tariffs raise the price of our imports, which means we pay more as consumers. You can think of it as a consumption tax, and it's money that leaves our economy. The administration is hoping to make President Trump's first-term tax cuts permanent, plus cut those taxes even further by the amount of revenue generated from the new tariffs. Essentially, the president wants to put the money tariffs will take from our pockets back into our pockets with additional tax cuts. But what happens if Congress doesn't go along with the president's proposed tax plan? All of us will see a big tax increase from President Trump's first-term tax cuts going away, plus the additional consumption tax the tariffs will create. The combination will be one of the largest, if not the largest, tax increase in U.S. history. And if that's the scenario that plays out, there is zero doubt we will plummet into a recession, and it won't be a mild one. Now, I would like to touch on the stock market because I believe it's near and dear to all of our hearts. I know it is mine. My main business, Global Financial Services, is an investment firm, so equities, fixed income, and real estate are always top of mind. Then here at National Indoor RV Centers, the single largest driver of demand for motorhome sales is the stock market. When people feel wealthy, they purchase motorhomes. When they don't feel wealthy, like during the month of April, they don't purchase motorhomes. And lastly, like most of you, my retirement is invested in the stock market. So the stock market has been the first thing I think about when I wake up in the morning. It's the last thing I think about before I go to sleep, and it has occupied most of my time during the day for my entire 45-year career. The point I want to make here, and I want to make it very clear, tariffs had nothing to do with the stock market correction in April. And please let me explain by way of the actions we took. We felt the S&P 500 was overvalued by 20% in September of 2024 when we prepared our 2025 projections for the motorhome market. And as I've said in almost every video I've made about the economy, we do eat our own cooking. If I say something in a video, you can take it to the bank that we have deployed our own capital accordingly, and this video is no exception. By the end of 2024, at Global Financial Services, the percentage of cash we were holding was at the highest level it had been since August of 2021, just before the correction began in November of 2021. By the first week in February of 2025, we felt the S&P 500 was overvalued by 25%. We saw valuations which occur less than 1% of the time. So, on February 3rd, 2025, we purchased June 500 put options on the S&P 500 ETF, more commonly referred to as SPDRs, for a price of $3.90 per share. As you can see from the chart, SPDRs were trading at $601.78 per share at the time of our execution. At the same time, the volatility index, or more commonly referred to as the VIX, was at 17.21. The VIX is a measure of market volatility. The VIX doesn't care which direction any particular stock or the market is moving. It only measures the rate of speed it's moving in either direction. When volatility is low, it means the stock market isn't making rapid movements. The market is calm. There is no fear or excitement. Emotions are low. When volatility is high, it means the stock market is moving rapidly. The market isn't calm, and there is a lot of fear or a lot of excitement, depending on which direction the stock is moving. When volatility is high, it means emotions are running high. Readings below 20 are considered low, and readings above 30 are considered high. Hence, the trader's adage regarding volatility, that when it's high you buy, and when it's low you go. So, in the case of put options, we were betting the market was going to go down. So we purchased puts when the VIX was low, when the market was calm, and had very little emotion. And the reverse was true when we sold our put options. We sold when the VIX was high, and signaling that fear was also high, which is exactly what happened when the market dropped. While we sincerely believed the S&P was overvalued by 25%, we've always played the game scared. We decided when we purchased our put options, we would sell them once the SPDRs had dropped 20%. We were never going to hold out for a 25% decline, simply because we're not that good, and pigs get fat while hogs get slaughtered. We knew once we saw the SPDRs down 20%, we were going to sell our put options. And that is exactly what happened on the open of the morning of April the 7th, 2025. As you can see from the trade confirmation, we sold our put option position for a price of $28.37 per share, or a 727% gain. I walked you through this trade to clearly make the point that tariffs didn't have a swinging thing to do with the stock market correction in April. When the stock market is grossly overvalued, it will always correct. Period. End of story. What we never know is what lame excuse the correction will be blamed on. Why? It's because professional money managers, including mutual fund managers, hedge funds, and other institutional investors, control a significant portion of the U.S. stock market. The most recent data shows they manage approximately 80% of the market's total assets. This includes the vast amounts of monies invested in various funds and managed accounts. I have never once heard a money manager tell a client the value of their account dropped because the manager purchased overvalued stocks for them. Remember, when you invest in the stock market, you are investing in a business by buying shares in the business. You have the option to sell those shares at any moment. So that means every day you hold a stock, you essentially made the conscious decision to purchase the stock again that day because its price still represented a good value to you. When a manager doesn't know the value of the businesses he has his clients invested in, then it's inevitable he will have them in overvalued stocks someday when a correction happens. And self-reflection coupled with confessions to his clients isn't good for customer retention. Hence, every stock market correction in history finds an excuse to blame it on, and that excuse has never been a contributing factor to the overvaluation of the stock. Tariffs didn't create the overvaluation of the stock market. Years of monetary and fiscal stimulus in historic amounts, coupled with inflation, created the overvaluation of the market. No tariffs had been announced on February the 3rd, 2025, when the market was calm and we purchased our put options. President Trump didn't announce his tariffs until April the 2nd. And for most businesses in America, tariffs should have caused their stock prices to go up if they weren't already overvalued. And I'll take a moment to explain this so you don't think I have lost my mind. Businesses aren't taxpayers, they are tax collectors. Every tax ever imposed on a business has been added to that business's cost of goods sold and passed on to their customers. No business has ever said, we will lower our profit margins and we will reduce the return on our equity by absorbing this new tax. Our politicians love to tax businesses because it's a hidden tax. Individual taxpayers still pay the tax through increased prices for the goods and services they purchase. Because taxes on businesses are a hidden tax, it allows politicians to pull the wool over their constituents' eyes. Now, tariffs are just another form of a tax, a consumption tax, if you will, but at least tariffs aren't a hidden tax. And yes, we as consumers will pay more for our stuff because of the tariff. Hopefully, we will get it back through tax cuts. But I'm asking you to look at tariffs through the lens of most businesses. Not all, but most businesses. Let's say your business manufactures bottled water here in America and you sell it for $1 a bottle. And let's assume you must compete with a bottled water manufacturer in, say, Fiji, who also sells their water for $1 a bottle here in the United States. Now, let's assume the U.S. places a 25% tariff on bottled water coming from Fiji. Your competitor in Fiji must now sell his water in America for $1.25 a bottle. How is that a bad thing for your business? You can now increase the profits of your business in one of two ways. You can choose to keep your price at $1 per bottle, which will increase the volume of your sales because you are so much cheaper than the Fiji manufacturer. Greater volume means you make more money. Or you can choose to increase the price of your bottled water from $1 a bottle to something closer to $1.25 a bottle, where your competitor from Fiji is now priced. Your volume of sales won't go up, but your profit per bottle just went up 25%. Either way, your business will make more money if tariffs are placed on your foreign competitor. So, why would the value of your business plummet 20% in 2 days when you're going to be more profitable? The only answer is your company was already overvalued. I get there are going to be some retailers who rely on cheap imports who will be hurt under this scenario, but not the entire stock market. I have posited the stock market was overvalued and due for a correction, and tariffs weren't the cause of either the overvaluation or the correction. I have also posited that tariffs should increase the profitability of most American companies versus their foreign competitors, which should have made their valuations go up and not down. I will now posit one more scenario and then let you be the judge of whether tariffs played any role beyond being a convenient excuse for the stock market correction in April. The total value of the U.S. stock market prior to President Trump's announcement of tariffs was $66.77 trillion. This includes companies listed on all 3 of the major exchanges. As you can see from this chart, the S&P 500 dropped from its peak of 6147 to a trough of 4835, or a 21.4% decline. I am going to use the S&P 500 as a proxy for the entire stock market because it's market cap weighted, which makes it a dang good proxy. A 21.4% drop in our stock markets was approximately $14.3 trillion. I would submit a drop of $14.3 trillion just because the president announced the potential of $411 billion in tariffs is an extreme overreaction. So much so that it can only bolster the argument that our stock market was overvalued and due for a normal correction. Now, for those of you who are still awake, believe me, I've been fighting to stay awake as well here on camera. As I promised at the beginning of this video, I will finish up with my thoughts about the motorhome market. What will be the impact of the Trump administration's tariffs on motorhomes? Thankfully, we have seen this film before. President Trump imposed tariffs in his first term, which spanned the 4 motorhome model years of 2018 through 2021. Let's look at how much motorhomes went up in price for those 4 model years with tariffs, and then let's compare those 4 model years with the price increase for the 4 model years of 2022 through 2025. Since all our dealer-seller service agreements prohibit me from showing invoices, I will be using MSRPs for this little exercise. Don't worry, MSRPs still produce the exact same inflation rate for motorhomes as using invoices would have. For this exercise, I will use the Newmar Dutch Star 4369 on a Freightliner chassis for all 8 years. Let's start by comparing the MSRP of a 2017 Newmar Dutch Star 4369 to its MSRP for model year 2021 to capture the total increase in price for the 4 full model years 2018 through 2021. The MSRP for a new 2017 Newmar Dutch Star 4369 was $445,397, and by model year 2021, it was $520,212. The Newmar Dutch Star increased in price at a compounded annual rate of 3.96% under the President's first term in office with tariffs. Now, let's see what the price increase was during the Biden administration by capturing the 4 full model years 2022 through 2025. We already know the MSRP for a new 2021 Newmar Dutch Star 4369 was $520,212, and by model year 2025, it had risen to $740,081. The Newmar Dutch Star increased in price at a compounded annual rate of 9.21% under the 4 years of the Biden administration. Motorhomes increased 2 1/3 times faster under the Biden administration than they did under the Trump administration. Clearly, tariffs weren't the root cause of inflation in motorhomes. Personally, as a motorhome dealer, tariffs are a big yawn for me. I'm sure it will cause some temporary discomfort for our manufacturers with their supply chain. I suspect it'll be a bit like having one foot in a bucket of ice and another in boiling water. On average, their temperature will be fine, but it sure will be uncomfortable for a while. Let's take a minute to look at what is always the core of any industry: supply versus demand. Consistent with our prior videos, we believe we are in the final year of a 4-year downturn. Unless manufacturers go hog wild and start overbuilding again, we believe the bottom of the motorhome market will occur sometime during Q1 of 2026. From their peak in this cycle, Class A diesel coach sales are currently down 54.2%. We believe at the bottom, the total drop from peak to trough will be 57%. Making this the second worst downturn in the industry's history. For some perspective, the industry's worst downturn was an 81.5% decline from its peak to its trough. It began in 2005 and lasted 5 years, ending in 2009. The remaining 5 downturns have averaged a 27.1% decline from their peaks to their troughs and have lasted an average of 29 months. If you remember this chart from my video a little over a year ago, we were looking at a 15.7 month supply of motorhomes sitting on dealers' lots by the end of 2024. 15.7 month supply versus a normal supply of 6 months given current flooring rates was going to be very problematic. Thankfully, manufacturers only built and shipped 34,891 motorhomes during 2024, and not the 52,900 motorhomes the RVIA was projecting. Retail sales by dealers were a bit better than we had projected, but those extra sales came at a heavy cost to both manufacturers and dealers alike as they tried to right-size their inventories. So, where do we stand today? Well, There are currently 19,343 new motorhomes on dealers' lots versus trailing 12-month sales of 35,431 units, or a 6.55 month supply. So we are getting very close to the steady state of a 6-month supply. While final pricing is not yet known, the price increase of the new CARB, ACT, EPA compliant engines, which will be in model years 2027 coaches, are anticipated to be $30,000 to $40,000 more dollars than the engines currently being used in the new model year 2026 coaches. When you factor in the stock market's volatility, the 57% decline in Class A diesel coach sales from its peak, current dealer inventory levels, and the looming price increase of engines, this sure feels like what a market bottom feels like. Remember, prices always reach their lowest before sales reach their bottom. When sales reach their absolute bottom, it means supply and demand are in equilibrium and prices are rising. My point, if you're contemplating purchasing a motorhome, sometime over the next year will certainly be the time to do it. On a relative basis, prices will not be this favorable until we reach this point again in the next cycle, 7 to 10 years from now. Given this is the second worst downturn in the industry's history, there's only a 25% probability prices will be as favorable as they are this year at the bottom of the next downturn. I truly believe the window is 12 months, and remember, it takes 4 to 6 months to build a motorhome. I mention that because at the price motorhomes cost, I have personally always ordered exactly what I wanted as opposed to settling for whatever was on dealers' lots. While everything I have stated in this video is what I sincerely believe given the current data, and I am also acting accordingly with our own capital, I will now digress and close this video with a shameless plug for our annual Music City Motorhome Expo. Our expo will be at the Wilson County Fairgrounds in Lebanon, Tennessee, just outside of Nashville. If you're considering purchasing a coach sometime over the next 12 months, this is the VIP shopping experience you were looking for. The Expo is where all the new model year coaches are on display for the first time for the public to see. All the manufacturers and major component suppliers will be there to answer any questions you may have. Plus, you can test drive as many motorhomes on display as you would like. Last year there were over 800 test drives, and this year will easily top 1,200 test drives. And you will be test driving with a factory representative. The event is for 5 days and 4 nights. All meals, snacks, drinks, entertainment, seminars, and camping are provided for and included in your ticket price. This year's entertainment is Sarah Evans, Scotty McCreery, and a Nashville singer-songwriter round. The expo starts on May 31st and goes through June 4th. We use the ticket price to essentially pre-qualify real buyers since this is a VIP shopping event only. This is also a capped event. We cap ticket sales at 2 tickets per coach on display to ensure you never feel crowded. You can spend hours alone in a coach if you would like, and you will not be tripping over baby strollers or dog leashes like you do at a shopping event which is open to the public and not capped. Should you purchase a new or used coach within 12 months of the expo, your ticket price is refunded to you. Plus, we will pay you an additional $2,000 if you purchase a Class A or Super C motorhome, or $1,000 if you purchase a Class B or Class C motorhome to help defray your travel expenses to and from the expo. We want to provide you with everything you need for making the most informed buying decision by letting you shop all the manufacturers in one spot at the lowest prices you will see for the entire model year for that same coach, and not have it cost you anything to travel and attend if you are a buyer. Just an FYI, as of the recording of this video, there are only 34 remaining tickets to be sold. After that, the event will be sold out and closed to anyone wanting to attend. With that, I would like to thank you for taking this much time out of your life just to listen to my musings. I wish you all safe travels and only the best, and thank you for watching.